Ethereum difficulty bomb delayed, but network adoption still growing. Ethereum network developers have announced a delay to the difficulty bomb, a key component of the upcoming merge upgrade for the Layer 1 blockchain. The decision was made in order to ensure a smooth and successful transition to the new system. Core developer Tim Bieco stated in a tweet that the delay was set to 2 months in order to ensure that all the numbers were checked before choosing an exact delay in deployment time. The difficulty bomb is a measure that will discourage ETH mining operations from keeping their physical mining devices running as the network transitions from proof of work to proof of stake. The difficulty bomb is a feature of the Ethereum network that was added in 2016. It was added as part of the plans to transition the network to the consensus layer, formerly known as ETH 2.0. The difficulty bomb makes it increasingly difficult for miners to verify transactions on the network, eventually to the point where it will be impossible for physical miners to validate a block. This reduces profitability for miners and may incentivize them to switch to other protocols. According to some estimates, transitioning to POS could reduce the Ethereum network's energy demands by up to 99.9%. Other POS networks such as Polygon and Phantom Opera have negligible power demands compared to other POW networks. Bieco does not mention it, but delaying the difficulty bomb could lead to further delays for the merge itself. The merge is expected to take place in August 2022. The Ropsten testnet on Ethereum recently completed a successful merge to POS on June 9th, which developers referred to as the first dress rehearsal for the real merge. The Ethereum user base remains strong, with daily transactions on the network staying above 1 million since December 2020. This simple metric provides a clear picture of the overall load on the network. Since December 2017, the number of unique Ethereum wallets has increased 14.5 times to 198 million. There has been no slowdown in the number of new unique wallets created each month. The price of ETH has decreased by 6.8% over the past 24 hours and is currently trading at $1,360. Let me know where you guys think Ethereum price is going to go. Up next here, Yougo Labs co-founder pre-warns possible attack, claims a Twitter insider is involved. Gordon Goner, co-founder of Yougo Labs, issued a warning about a possible incoming attack on their social media accounts after receiving credible information that an insider from Twitter could help bypass security measures. Yougo Labs has proactively approached Twitter for security after receiving information about a soon-to-happen orchestrated attack on its social media accounts. This attack would target some of the most popular NFTs, including the Bored Ape Yacht Club and Otherside. Twitter officials began actively monitoring the activities on the accounts and fortifying their existing security measures after issuing a warning to the community. Goner informed investors that the company would never conduct surprise mints, which is a popular method that attackers use to lure in victims. Yougo Labs' popularity and public demand for NFT offerings resulted in the rise of ape-themed scams. On June 5th, attackers breached Yougo Labs' BAYC and Otherside Discord groups and made off with over 145 Ether. According to OK Hotshot, a blockchain detective, the attack was conducted by hacking into the Discord of Boris Wagner, community and social manager at Yougo Labs. An Optimism Layer 2 scaling solution lost 20 million OP tokens after an exploit was found in the smart contract of its market maker. 1 million tokens valued at $1.3 million were sold, and 1 million tokens valued at $730,000 were transferred to Vitalik Buterin's Ethereum address on Optimism. The remaining 18 million tokens can be sold or used to sway governance decisions. Up next here, Do Kwon dismisses allegation of cashing out $2.7 billion from Luna UST. Do Kwon, the CEO and co-founder of Terra and Terra USD, has refuted claims that he has been cashing out $80 million every month for nearly 3 years. There were many unconfirmed reports on Saturday claiming that Kwon participated in draining liquidity out of Luna Classic and Terra USD Classic before the crash to purchase United States dollar-pegged stablecoin such as Tether USDT. After a Twitter thread by Fatman Terra surfaced alleged details of how Kwon, along with Terra influencers, managed to drain funds while artificially maintaining liquidity, rumors began to circulate that Kwon had cashed out Luna and UST reserves. The entrepreneur advised the crypto community not to fuel the rumor until it was proven true. They said that the claim that they had cashed out $2.7 billion from anything was categorically false. Kwon stated that the recent rumor of cashing out $80 million per month is false, and that he still holds most of his Luna token holdings, which he acquired during the airdrop. He went on to say that his only income over the past 2 years has been from his cash salary at Terraform Labs. Kwon told the community that spreading falsehood adds to the pain of all Luna investors and that he lost most of his investment in the crash as well. He remarked that he doesn't care about money much. According to Mr. B, a developer from Anchor Protocol, the interest rates offered by the Terra platform are unrealistically high and not sustainable in the long term. He claims that the platform was originally designed to offer an interest rate of only 3.6% in order to keep the Terra ecosystem stable, but that this was changed to 20% just before the release. Mr. B stated that he designed the building with the expectation that it would collapse, but it collapsed 100%. The developer is alleged to have suggested to Kwon about lowering the interest rates, but the request was refused. Kwon has been summoned to attend a parliamentary hearing on the matter in South Korea. We will definitely keep you guys updated as that develops. Up next here, Coin Center takes U.S. Treasury to court over alleged financial spying. Coin Center, a Washington, D.C. based non-profit blockchain advocacy group, filed a lawsuit against the United States Department of the Treasury for allegedly provisioning an unconstitutional amendment in the controversial infrastructure bill. In an official announcement, Coin Center revealed that it has filed a suit against the Treasury Department in federal district court. The suit challenges the enforcement of Section 6050I's reporting mandate within the Infrastructure Investment and Jobs Act. This lawsuit stated that in 2021, President Biden and Congress amended a little-known tax reporting mandate. If the amendment is allowed to go into effect, it will impose a mass surveillance regime on ordinary Americans. Per the 6050I amendment, any individual or business that receives incoming transactions worth $10,000 or more is required to report certain information about the sender. This information includes the sender's name, date of birth, and social security number. In its announcement, Coin Center highlighted how the amendment affects the entire crypto community, including the NGOs that receive anonymous donations and non-fungible token artists who will have to reveal their clients' personal information to the government. In the first claim of the lawsuit, Coin Center alleged that the 6050I provision is not aimed at collecting information about the third parties, but rather focuses on the information about the general public participating in crypto transactions. The second claim pertains to our freedom of association, as noted by a Supreme Court ruling, which prevents the government from requiring organizations to compile and submit lists of their members. At the end of their statement, Coin Center asked for support from the crypto community, saying that they are looking for additional co-plaintiffs for their suit. Cointelegraph discovered a leaked copy of a United States draft bill concerning cryptocurrency on Twitter last week on June 7th. And here is a picture of that at bot_slam tweeted that out. After further investigation, regulators were concerned that user protection across the decentralized finance, stablecoins, decentralized autonomous organizations, and crypto exchange systems. So hopefully you guys can figure out some people that will be able to help in terms of this, because it definitely seems like this was slipped in there and not something that we want to pass. Up next here, NFT flipping, not so profitable for more than half of buyers. As the popularity of non-fungible tokens continues to grow, more and more people are using them as a trading strategy. In a recent survey, 64% of people said that their main reason for buying an NFT was to make money. In a recent poll of more than 1,300 people on Twitter, blockchain monitoring software company Dexter Lab found that despite a majority looking to gain from NFT trading, less than 42% have made a profit so far. 15% of the respondents said that they buy NFTs because they want to be part of a community, and others do it to show off their wealth. The Bored Ape Yacht Club has seen much success since its inception, attracting celebrities and offering exclusive perks and events to members. Recently, the club has seen an uptick in popularity due to the introduction of new NFTs. Almost half of respondents indicated that they were only comfortable paying a modest price of between $50 and $500 for an NFT. This is in contrast to NFT collections that can often see floor prices in the tens or hundreds of thousands. Over the past 30 days, some of the largest blue chip NFT collections, such as CryptoPunks, Mutant Ape Yacht Club, BAYC, and Moonbirds, have seen their floor prices or market caps halve. In spite of this, these collections have continued to top the charts for the top NFT sales over the same period. Goblin Town, a free-to-mint collection with no utility or roadmap, has topped the charts and remained in third place for over 30 days with nearly $70 million in volume. Currently, the minimum price for a piece in the collection is 3 Ethereum or around $4,000. The most expensive piece sold to date went for 77.7 ETH on June 1st, worth nearly $151,000 at the time. Sales volume for NFTs were $3.7 billion last month, according to a recent DappRadar report. This points to a healthy market for those who are still holding out to profit from their NFT purchases. According to the report, Solana NFTs had their best trading month yet in the network's history, generating $335 million in volume across all marketplaces. This is a 13% growth from April. As the NFT market continues to grow and gain mainstream adoption, it is projected to transact more than $800 billion over the next 2 years. However, holders will need to wait a little longer to realize their profits. Last but not least here, Bitcoin hash rate marks all-time high as BTC price drops below 25K. As the Bitcoin price falls below the $25,000 mark, the hash rate, a measure of the network's security based on mining power, reaches a new all-time high of 231.428 exahashes per second. The hash rate is the amount of computing power dedicated to confirming transactions on the Bitcoin network. The higher the hash rate, the more secure the network is from bad actors manipulating on-chain transactions. The recent all-time high in hash rate is a positive sign for the security of the Bitcoin network. The network difficulty, which measures how difficult it is to find a new block of transactions, is also at a high of 30.283 trillion. Some of the most popular Bitcoin mining pools based on market share include Poolin, Antpool, F2 Pool, Via BTC, and Slush Pool. However, a majority of the total hash rate is contributed by distributed miners shown as others in the graph below. Despite the market crash that threatens the existence of numerous crypto projects, the Bitcoin ecosystem continues to strengthen its core. It consistently records new all-time highs for hash rate, network difficulty, and network capacity. In addition, the Bitcoin Lightning Network increased its capacity to 4,000 BTC, furthering its goal to enable faster and cheaper peer-to-peer BTC transactions. Bitcoin remains well positioned to be hosted on the most secure blockchain network in the world, thanks to the continued support from miners, traders, and developers. Block subsidiary TBD has announced plans to build Web 5, a new decentralized web centered around BTC. This move underscores founder Jack Dorsey's belief that the largest blockchain network will play a major role in the internet's evolution. In contrast to Web3's goal of decentralizing the internet, Dorsey envisions Web 5 as an identity-based system that runs only on the Bitcoin blockchain. As previously explained by Cointelegraph based on TBD's prototype documents, Web 5 as a decentralized web platform allows developers to create decentralized web apps via DIDs and decentralized nodes. So that is all we have for you today. Thank you so much for watching. Make sure to like, subscribe, hit that notification bell, leave a comment on what you want to see in a future video, and we'll see you next time.